Welcome back to our part 2 of Module 3, where we're going to be continuing the topic of current assets. So the next current asset we will cover here is the accounts receivables, and we talk about bad debts as it relates to it. So first of all, we'll provide an overview of accounts receivables. Accounts receivables are generated when a company has credit sales where they sell something to the customer and they say, hey, you don't need to pay me immediately, pay me back in 30 days, 60 days, maybe 90 days. They tend to not be longer than that, but the point is it's payment over time. And in fact, the sale is sometimes called a sale on account or sale on credit as opposed to a cash sale. But it's current because it's very short term. Now, we have to record these in individual accounts. We've talked about accounts receivables in previous modules, but now we're going to dig into more detail. We have to record the accounts receivables on a customer-by-customer basis so we can track the payments they make and how much is left that they owe us. Now, we'll briefly talk about the difference between accounts receivables and notes receivables. The notes tend to be more formal than an account. Account is just when you sell a product to a customer and there's just an informal agreement that, hey, they'll pay within 30 days. You send them an invoice, basically. With a note receivable, it's generally related to borrowing money and they sign a promissory note, but occasionally you'll see where they need more than the normal 90 days. So instead of just having that informal arrangement, they'll negotiate with you and actually sign a promissory note promising to pay within maybe 120 days or a year. Possibly longer, not generally, for that purpose. So notes are more formal. They have a promissory note, a financial instrument attached to them. Notes tend to be a little bit longer in length. They may not need to be, they don't have to be long-term. They can, though. Notes receivables can be either short-term or long-term, depending on the situation. Because they tend to be a little bit longer term than the accounts receivables, there's generally interest attached to them, and it's part of the promissory note. So let's take a look at a few examples here of sales on credit or on account. It's the same concept. On July 13th, Severco sells $950 of merchandise on credit to Flexter, and then they sell $1,000 of merchandise on account to Skylar Incorporated. Again, it's the same thing. So the entry will be the same except for the dollar amounts and except for the fact that a different customer is attached to each accounts receivable. In both cases, we're debiting accounts receivable for the corresponding amount and the corresponding customer to increase that accounts receivable, and we're crediting sales to record a revenue. Now here's what that would look like. You have what's known as an accounts receivable subsidiary ledger. Subsidiary just means it's the detail, basically, of each customer. It's the breakout. So you can see their balance. This would generally be carried over to a schedule of accounts receivable, and then you get a total amount that actually moves to the true general ledger, the general accounts receivable that you tend to see on the balance sheet. You're not going to see on the balance sheet a list of every customer by any means. You're going to see one general accounts receivable balance. You need to see the detail internally, but not externally. So we have this same transaction here. We're not repeating it. We're just refreshing your memory about it. And now on July 31st, Skylar Incorporated pays their bill in full. So we're debiting cash to increase it, and we're crediting the accounts receivable asset for that customer to reduce it. They no longer owe us the money. But let's assume the other customer doesn't pay at all. So we cannot do this journal entry for that customer. They haven't paid. So now we bring up the topic of bad debts. It's considered the cost of doing business. If you're allowing for flexible payments, then unfortunately you're generally going to have some customers, for whatever reason, intentionally or unintentionally, that can't or won't pay their bill. So the question here is, what do you do with that? It's considered a cost of doing business again. Now, this is something in accounting that is actually changing. It's been changing. It's been in flux for the past couple of years, few years. Traditionally, this was considered an expense, a bad debt expense, just like any other expense, utilities, rent expense, salaries expense. So you'd have all of your revenue at the full price, the full amount of the sale, and then in the expenses you'd have an offset for the amount that was not able to be collected for whatever reason. The change that GAAP is making for the bad debts is that now, instead of having it as an actual expense, they're requiring it to be treated as an immediate revenue offset. So let's just give a very simple example. If you had a $1,000 sale and you, for whatever reason, you expect historically that maybe 10% of your accounts are not collected. So you think in that case, out of the $1,000, chances are you'll collect $900 of it. They want to see that recorded at $900 revenue. Now, you might see a gross revenue and then an immediate, it's called an implicit price concession or a contra revenue account. It offsets the revenue immediately. So you'll see the $900 included in revenue overall, and you'll never see an expense related to it. So the end result is the same. You have the same net income figure, whichever method you use. It's just a difference of, do you include the gross revenue and then subtract out expense, or do you just take care of it all in the revenue section and reduce it there? That's the main difference. We, for the purposes of this video, are going to be talking about it from the expense perspective. Some of the treatment is the same. It's, again, just a question of, do you handle it as an expense or a revenue offset immediately? So here we have what's called the direct write-off method for this. And this is a very basic method. And we're saying on October 13th. Now, remember, this was a July 13th sale. By the time October 13th comes around, they've tried to collect from Flexner and they just realize they're not going to be able to. They waited a while. They billed a few times. The point here is we don't want them to leave the accounts receivable amount as an asset if we really don't think we're ever going to collect it. We don't think there's really any value. So the point is we want to get it out of the asset. And of course, as we said earlier, we need to either include it as an expense or possibly as a revenue. I'll kind of mention both approaches. But the direct write-off method would basically say, hey, let's credit this customer's accounts receivable to pull it out of the books, pull it off of the balance sheet. Now, the point I want to make here is they still owe the money. It's not like all of a sudden it's gone, they don't have to pay us. We just don't want it being recorded in accounts receivable if we don't think it's a valid, valuable amount. Now, the debit, in our example, is going to go to bad debt expense, but in some cases, this might go to a contra revenue. Remember, anytime you see contra, that offsets whatever account it's contra to. So revenue has a normal credit balance. A contra revenue would have a debit balance. So if we were to debit bad debt contra revenue or implicit price concession, whatever term they use, it'd be a debit to that. The point is it's still going to be a debit to something, whether it's an expense or a revenue offset. Again, for the rest of this video, we'll just focus on the bad debt expense treatment just for clarity. Now, the problem with the direct write-off method is that it's not GAAP approved. It violates the matching principle, and the reason for this is that in our example, we went from July all the way to October before we found out this customer was not going to pay, before we recorded a write-off. Now, that might be in the same year, but let's say we have a sale in October and we don't write it off until January or February. Now, all of a sudden, we've crossed over into another period, potentially. We've recorded revenue in one period, and the expense that kind of related to that revenue was not recorded until the next period. So that violates the matching principle. We don't want that to happen. the direct write-off method is more accurate because we now know this customer won't pay, or we're very sure about it, but it's just not timely. It's not being recorded in the proper time period. So GAAP requires the use of allowance methods, which are basically estimates of bad debts that we can record in that same period as the revenue. It's less accurate because it's an estimate, but it's more timely because we're recording it and we're matching it. Now, when we use the allowance methods, there are two different journal entries that come into play. The first one is the estimate, the estimated bad debt expense when the revenue was recorded to match it. But then the second one will be a journal entry to write it off when the actual bad debt is determined truly to be uncollectible. So let's look at the first entry. Now again, we're going to focus on the bad debt expense treatment. We would debit bad debt expense, but we cannot credit the accounts receivable because we don't know which customer to credit. As we said earlier, they're broken out by customer. Yes, we have the general accounts receivable, but we can't enter to that. We have to enter it on a customer by customer basis. So initially when we're estimating, we have to set up what's known as an allowance for doubtful accounts, sometimes called a provision for bad debts. It's basically an estimate. It's a fund that we're setting up to handle future write-offs that occur when we know a customer won't pay. So this is called a contra asset account because it's offsetting the accounts receivable. Assets have normal debit balances. Contra assets have normal credit balances to offset the accounts receivable. So by crediting this allowance, we're increasing it. We're setting up a fund for future write-offs. Now down the road, when we actually have a write-off, we debit the allowance account to pull money out of it, and we credit accounts receivable for whatever customer we find out won't pay. Now, don't mistake this as us paying their account off. That's not at all what the case is. This is just us handling the fact that this asset should not have value because we don't think we're going to collect it. They still owe the money, and we'll still have a record of it somewhere in our collection history documentation, but we just don't want it in the accounts receivable. It's not valuable at this point. So what we see here is we have a debit balance for accounts receivable, a credit balance for the allowance for doubtful accounts, and the way this shows up on the balance sheet is that you have accounts receivables less the allowance for doubtful accounts equals the net realizable value of accounts receivables. Now, those allowance methods, we talked about the journal entries themselves, but it's based on an estimated bad debt expense. Again, the thing is we don't know for sure which customer won't pay. That's why we can't reduce the accounts receivable. It has to be customer specific. So we increase that allowance account to offset the total accounts receivable. We talked about the journal entry, and we had just an amount they gave us. But the second stage of this is we have to figure out how do we really get that estimated bad debt expense amount. So for this, there are a few different common methods that are used that we have to consider. We have the easiest method is known as the percentage of sales method, and we'll see how these are used in just a bit. We have the percentage of accounts receivables method, and we have one that's very closely related to that second one called the aging of accounts receivables method. So let's dig through the percentage of sales method. Here we're saying that management estimates that 5% of sales will not be collected. By the way, when you're dealing with these types of questions and entries, they'll give you the percentage. That comes from management, it comes from actuaries, so they'll give you the estimate. Sales are $200,000. We think that 5% of those sales won't be collectible. So multiply the two together, we get $40,000. We have to charge our entry for $40,000. It's a debit to bad debt expense and a credit to that allowance for doubtful accounts to put that money in the fund, to add to that allowance. So what I want to point out here is the percentage of sales method directly gets you to that journal entry. Now we have, again, the debit to bad debt expense, credit to allowance for doubtful accounts. Now the percentage of accounts receivable method, and for that matter the aging method as well, they do it a different way. They'll still give you a percentage, but this time it's going to be a percentage of some sort of accounts receivable balance. So they say 5% of the ending accounts receivable balance probably are not going to be collected. If the ending accounts receivable is $200,000, then we take that by the 5%. We get $40,000 again, but it's a different $40,000. This is no longer our journal entry. Under the percentage of accounts receivable method, this is not the journal entry amount. Instead, it tells us what we want the allowance account to end up at the end. So we have to make an adjustment to get the allowance account from wherever it currently is up to $40,000, or sometimes down to $40,000. Usually up though. So let's say in this case, from last period we had a $15,000 beginning balance. We want to get it to $40,000. That's what we just calculated. To do that, we have to have an adjusting entry of $25,000. That's where we get the journal entry amount from under this method. So again, we put that $25,000 in as the journal entry. Now the aging of accounts receivable method is very similar. The difference is now instead of just taking one big accounts receivable balance, we're actually classifying them by age. In other words, how far past due are they? The higher the bad debt age, the higher the estimated percentage it gets, the more risk there is. But once you do that, it's the same basic process as the percentage of receivables method. So let's take a look at this example here. We have 0 to 30 days, 31 to 60 days. Fortunately, the balance for each older classification is dropping. The risk of each older classification obviously gets higher. By the time you get to 121 days past due, there's a very, very good likelihood you're not going to be able to collect that. Here they're saying 85%. So you multiply each category, the dollar amount multiplied by the percentage, and you get a grand total of your estimated bad debt amount. Now remember, that's not the bad debt expense. That's the amount we want to be into the allowance account to handle what we think the future bad debt write-offs are going to be. So we want to get to $4,830. Let's say we had currently a $1,000 balance, then our journal entry would need to be $3,830 to get up there. But also, it could go the other way. Let's say that our allowance account was already at $5,000 throughout all the entries that have happened up to this point. And now when we do this estimate, we think it should only be $4,830. We would need to take out $170 from our allowance account. So what that essentially does, it's the exact reversal of the earlier entry. It's the reverse of this. We would be crediting the allowance account to reduce some out. Or I'm sorry, we'd be debiting the allowance account to reduce some, that 170, and we'd be crediting bad debt expense to reduce that. And that's an odd entry. You usually don't credit bad debt expense throughout the year, but in this case we would if, in that second example I gave, we had too much and now we need to reduce it. So again, it's a fairly unusual situation. So now the final current asset that we'll talk about is one of the big ones for many companies. It's inventory. Now, as an overview of inventory, we're talking about what does the company normally sell? What are they in the business of selling? Obviously, that depends on the specific company. What one company sells might be another company's just equipment. Think of an equipment manufacturer. They're in the business of selling equipment, so it'd be inventory to them. But to most of the other companies that are their customers, it's just their regular equipment. They're using it. So that's the difference here. Same with supplies. They don't sell the supplies unless they're a supply sales company, of course. But if it's a company using those supplies, then it's not going to be inventory. So the concern we have here is tracking both the selling price of the inventory, what we sell it to our customers for, and the cost of the inventory that we had to pay to buy it initially, because now we're using that inventory up. So as an example here, a company purchases inventory for $60,000 and they sell it for $100,000. There's a markup of $40,000. You can see the percentage here. But the point is, you may wonder, why is there such a markup? Because there are a lot of other expenses that go into running this company as opposed to just buying the inventory. They have all the labor. They probably do something to the inventory. They may deliver it. All of that. So as an overview, we are trying to sell the inventory, and at that time, we have, of course, the sales price itself that we're going to handle. There's a sales portion of the entry, but we also have to convert that inventory asset to cost of goods sold, which is an expense. That's the amount we're actually using up. Now the big question is, the first question is, when do we make this transaction? The cost portion of the entry. Do we do it immediately at the same time that we sell the product? Or do we do it at the end of the period with all sales throughout that period? And that depends on what system they're using. If the company is using what's called a perpetual inventory system, then they would record everything every time they have a sale. So the sale would have two sections of the entry. The first one would be the actual sales price. The second one would be the cost. So the cost is what we initially paid to buy the inventory, and we have to reduce our inventory asset and increase the expense at that same time that we record the sales revenue. Perpetual here means ongoing, all the time, every transaction. Periodic means we only record that cost entry and the inventory entry periodically, one time every period. However, the selling price, the sales revenue, always needs to be recorded every single time we have a sale. There's no question about that. Now the sales entry is going to be, it doesn't matter what method you use, it's always going to be recorded every time there's a sale. You'll either have a debit to cash if it was a cash sale, you might have a debit to accounts receivable if it was a credit sale, and then you're going to credit sales revenue for $100 in this example. Now the expense entry, let's say it was a $60 product that we paid for it. We debit cost of goods sold for $60 to increase that expense. We credit inventory asset to decrease that. Now again, it's the same entry no matter what method you're using. The question is, when do you do it? Do you do it sale by sale every single time? Or do you lump all of these together for every sale and do it once at the end of the period? The section of the income statement that is really relevant for this would be the very first part of it. Sales less cost of goods sold, again, which is an expense, equals gross profit. There's more after that, as we've talked about in other income statement reviews, but this is what we're really focused with. Again, just a refresher, if it's the perpetual inventory method we're talking about, you're going to have both of these entries at the same time. If it's the periodic inventory method, we're only going to have the sales entry every time we have a sale. There will be no expense entry at that time, but it will take place later, all the sales aggregated together. Now, if we are using the periodic method, we have to identify what that total cost of goods sold is for all the sales. And generally what we do is we take the beginning inventory, which is the same as last year's ending inventory. We add in any purchases that we made. That gives us the cost of goods that are available for sale. We could sell these, but we maybe didn't sell them all. In fact, we didn't sell them all because we have ending inventory of 1,000. We have to subtract that out because we obviously did not sell that. And it leaves us with the cost of goods that we did sell, $900 here. Now let's continue on to talk about where those costs come from. In the previous slides, we just assumed that, hey, we knew what the cost of the units were. The problem is prices change over time, and even though we're selling the same units, the underlying cost, and for that matter the price, may be different in later sales. We sell some January 1st, we sell a few more January 15th. They may have had different costs, even though it's the same unit. Companies sometimes hold inventory balances on hand. If they didn't, if they seldom hold any extra inventory and they sell all their inventory immediately, then there's not a concern. But when they do hold a lot of inventory, and when you're faced with inflationary pressures, then you'll see cost changes. So when the price per unit changes, we need to determine which of those costs we use for our journal entry. Again, this is the journal entry. Which cost do we use? Maybe this unit cost us $60 at one time, $62 another time, $70 another time. We need to know which of those costs to use. So let's take a step back here and talk about physical flow of inventory. If we have a milk cooler or very perishable products, we want to make sure they're always using the oldest stuff first so it rotates. So with a milk cooler, it's loaded from the back so that the oldest stuff is always at the front facing the customer. So if they pull that milk from the front, they're using the oldest inventory first so that we try to avoid spoiled goods. Now, if you have a customer that reaches to the back of the shelf to try to pull the newer milk, they're reversing that physical flow. If everybody did that, nobody would ever grab the new or the front milk, the oldest milk, and you'd have spoilage. So that's physical flow. We're grabbing the oldest units first, the newer units stay in inventory. Let's take a different example, a rock pile. You have a landscaping company, and they have rock that's added to the top of a pile. And when customers come in and buy rock, they pull from the top of the pile as well. Nobody's going to dig to the bottom of that pile to grab the oldest rock. But for rock, it doesn't matter. It doesn't perish. Old rock, new rock, it's the same. And I do want to clarify, until we deplete the inventory and finally get down to those old layers. Then we'll use the old layers. That's the only time. So that's a key thing to think about. But again, we're talking physical flow here. Let's talk about this from a cost perspective now. Now, these prices, I just threw some amounts in here. They're probably not realistic. But let's just say 10 apples were purchased for 25 cents per unit. Then 15 apples were purchased for 22 cents per unit. 22 more apples were purchased for 26 cents per unit. They're the same basic apples, same brand, same style of apple, but inflation has caused the price to increase. Now let's say that we sell 8 apples. The question is, what cost do we use for our journal entry? Do we use 25, 22, 26, maybe some average? From a physical flow perspective, we want the older apples to go first so they don't spoil. So assuming this was the chronological order of those apples, we'd want the 8 apples to come out of this 10 apple barrel first. But that doesn't necessarily mean we have to use the oldest cost. The physical flow and the cost flow do not have to match. Sometimes they do. They don't always have to, though. So we have a few methods. We have 4 methods we'll talk about, but first we're going to talk about 2. FIFO and LIFO. First in, first out, and last in, first out. Now when we say in, we're talking about into inventory. It's the oldest one. It's the first one we brought into inventory, and it's the oldest item. It's also going to be the first one out of inventory, which means it's going to cost of goods sold. So it follows that the milk cooler example, we're rotating the stock, and in this case we're rotating the cost as well. It keeps it nice and clean. LIFO is the exact opposite. The last item that we brought into inventory, again cost-wise, it's the newest item. That's the first one we're going to grab out of inventory and take it to cost of goods sold. That's our rock pile example from a cost perspective. Specific identification is when we have some way of tracking the exact costs that went with that exact physical unit. Maybe they're really different products. They have identification numbers. whatever the case may be. With this method, physical flow, just by its nature, matches the cost flow. We could also use weighted average, but which, by the way, weighted average doesn't work physically, at least for most products. The only way it would really work is if you had like a vat of chemicals and you dump some new stuff in, it gets mixed with everything else, you pull it out. That would work, but most products, it just doesn't even make sense. But for cost flow, you certainly could use it. The point is, we get a weighted average cost per unit. In other words, the total cost of everything available at that time divided by the total number of units available at that time to get a weighted average cost. But this has to be updated every time our inventory changes. Every time we bring in new inventory, every time we sell inventory, we have a new weighted average cost. So let's take a look at some examples here. These are layers of inventory. They're just different lines where we had some inventory, number, cost per unit, a total cost for that layer, and then a running total. And we just keep adding more. You'll see the price is increasing. It's a normal inflationary environment. Now, I shouldn't say normal. Within this short period of time, that's pretty drastic, but it's done that way to illustrate that there is a change. So now let's say we sold 120 units on February 28th. By that point, we already have 2 layers of inventory. We haven't quite received the 3rd layer yet, so we're selling right in the middle. And then we sell 200 more units on 5/15 at the end of everything. So the question is, what cost do we use out of this listing? So for FIFO, it's pretty straightforward. We're starting with the oldest cost and working our way forward. If we are trying to sell 120 units, we go to the very first layer and, hey, we have 100 units available at $325, so we'll use those up, and then we have to take 20 units at $410. So we have the cost there. Now when it comes to the 200 units at May 15th, we basically, for FIFO, pick up where we left off. We have 60 more units left at $410. We'll move to the 125 units at $425, and then we'll grab our final 15 units that we need out of this 110 unit layer at $460. Now when it's LIFO, this can get a little bit tricky and a little bit messy from time to time. For the first one, on February 28th. Now the key thing here we have to know, is this perpetual or is this periodic? If it's periodic, we might not be making a cost of goods sold entry until the very end of the year, at which time LIFO, last in, would take the absolute last layer that's available when we're making the entry. But if this is LIFO perpetual, then we're making this entry every step of the way. And on February 28th, we only knew about these first 2 layers. So last at that point under perpetual is right here. We don't know about these other 3 at that point. So we would take 80 units at $410, and our remaining 40 units that we need would be taken out of here at $325. Which means, by the way, that we still have 60 units at $325 left. Fast forward a few months, and now we need to sell 200 units. But now we have a new last layer. We have more available to us. Even though we dug into this first layer, we're now skipping forward and using the new last layer. 95 units at $485 and 105 units, or our remaining 105 units that we need at $460. So what this essentially means, the problem with LIFO is you end up with a lot of partially used layers. Here we have a partially used first layer. We partially used this second to last layer. We eliminated the 80 at $410. We eliminated the 95 at $485. That's just the nature of LIFO. Weighted average. What we basically do at this point, and again, this also depends on whether it's perpetual or periodic, but we're assuming we're doing perpetual. So on February 28th, we have 180 units total, and it was $653. There's a typo here. $653 of cost. So our weighted average cost is $3.62 per unit. That's the cost we use. Now the problem with weighted average is that now once we add in more units and we're trying to make another sale, we need to recalculate a weighted average cost. So initially the weighted average cost was $362 from our last layer. And what we basically do with weighted average cost is we essentially destroy those layers now. Now what we have left is essentially 60 units at $362. We've used up 120 units at $362, so we have 60 units at $362 plus all these new layers. So what we need to do is calculate a new cost and a new number of units. In total, we had $2,151 in cost, but we already used $434.40 of that cost, which was basically 120 units multiplied by 362. That's what we sold in the first layer. So we have to subtract that out, and our new remaining cost is $1,716.60 divided by the remaining units of 390, which is our total 510 units minus the 120 that we used up. So we get a new weighted average cost of $440 per unit that we'll use for this costing entry. So weighted average can get kind of messy there. So that takes us through our discussion of inventory. Again, what you need to know for this level of accounting. The important thing to know is that inventory cost is either in the inventory asset when we first purchase it and are holding it, but eventually it's moved in the cost of goods sold expense. So it moves out of the asset into the expense, but the point is that inventory has to be in one of those two places. We try to match that expense with the revenue in the period of sale. And again, we need to understand the costing methodology that we used, FIFO, LIFO, weighted average, whatever. We need to understand that. So that takes us through our discussion of inventory and current assets in general. Hopefully this has helped to clarify these topics. I look forward to talking to you in the next module. Thanks for your time.